Hello, this is Coach Mike from winningstockcoach.com. Gonna go over a little bit of a demonstration / video lesson on how I use the Fibonacci Extension tool to project price targets and provide support and resistance points. The Fibonacci Extension tool is a 3-point tool that many brokers have available as a tool for you to use on your charts. And it gives projections based on the replication of a percentage move, but from a new point. I know that might not make sense to you right now, but you see I'm using Thinkorswim here, and we're going to go to Drawings and Fibonacci Extensions. Now, I'm just looking at a chart for LinkedIn, just a random chart here, and it's a 1-year daily. And I'm going to start up here towards these tops, and I'm going to start looking for opportunities based on, once I identify a lower low being made. As you can see, in this case it's making higher highs, higher lows. It makes a lower high followed by a lower low. So right away I'm thinking, on the next high, this is going to be a shortable opportunity. And I then draw my 3 points from this high, the following low, and the high that would have just happened at that time. Now, what would that look like at that time? Well, that's really simple. If I take my chart and go back and scan back a little bit here, what you'll find is that as this is taking place in real time, when I get to this point, as I identify a chart pattern, this one happens to be an evening star, I'm able to decipher a target. Now, in this case, I can see the target because it already happened. But let's look at things, and we'll go through this. You can see how connecting this high, this low, this high, pretty accurately predicted a point, at least so far from what you can see, that we could have planned as a target on the trade. Now, as I kind of go forward in this, there are some prices below. But you notice we get to this point in time here, and it really looks like this chart may be bouncing. We had a big solid up day and another green day here. So what I do at that time is I run me a couple different sets. Now, because of the points that were accurate before, I will then go from this low to this high to the low that was made down here. Now, this is telling me that if it were to replicate the move made from October 9th, 2013 to the high on October 21st, 2013, but starting from this point, it would reach a price of 248.51. But if you look here, there was also another little move right here. So oftentimes I will run a subsequent set of Fibonacci's, and I actually tell myself, you know what, once it gets over that point, I'll be confident that I may get this point. So as you can see, 2 days into this one, it's already over that point. Now I'm just going to scan forward here. As you can see, after this day here and the following day, we got over the point from that lower set of Fibonacci's, and I'll put them back here on the chart so you can see it. But with those back on the chart, after we got over that hump, so this day, November 14th, would have been our entry day for that long. Let me take this back out. And you can see that as the next day comes, we are actually gapping up and looking like we're on our way to our target. Now let's kind of progress through here. The next day we come down and we fill the gap, so it makes us feel kind of bad. And one thing we have to observe, there's a lot of lines I could have using this tool. I could have a 236, a .382, a .5, a .618, .786, the 1, the 1.618, 2.618, 4.236. I like to just use the 0, the 0.5, and the 100, but most of the times I don't even use the 0.5. But in a case like this, when I am able to kind of get to this point, I start to look at how the 50% can many times serve as a resistance. Now, as this trade progresses and we start watching, what you end up finding is that, wow, this kind of got right up into the 50% area and began to pull back. Now, if I was long on calls, I wouldn't necessarily sell my calls just because it pulled back on this day. What I would very likely do is I would enter a puts trade to kind of strangle and leverage myself until I got a good sense of what was going on here. Now, my puts target may be based on a couple things. I'm going to run a set of Fibonacci extensions from this high here to my low and to this high. And you see it gives me a 211.73 target. But I also got to go back to the high that we used before, my low, and this high, which says, ooh, this could come down to 187.34. So now I know the chart is starting to look a little bit cluttered, but I want you to stick with me for just a second here. As we begin to progress again here, what you're actually going to find is we come quite close to this 100% line, and now we're starting to tool around with the 50% line for our downward projection using our Fibonacci's. And now all of a sudden, you see we put a wick and we hit right on our first projected downside target. Now this can be really, really important because sometimes things change with a trade. When we made this hit and we pulled back up, the next day being a confirmation day, we would then have to look and say, well, you know what? This set of Fibonacci's definitely had proved to be a good and accurate set. So we're going to have to use that in projecting a new potential target, because charts are constantly changing. And though we had our old target that we're still in that trade for, and over in here we would have sold our puts and hey, we hit our target, the next day we're moving up, we're looking for any opportunity that day to exit those puts. So even though our calls may have gone down, we made money on the puts to kind of even things out there, allowed us to remain in our calls play, and now we've got a new target popping up on our chart. Now, I'm not saying to just sell it right at the target no matter what. You always let something hit your target and pull back from it first. But you have to be flexible in the way that you're trading. So as we continue to progress here, you see that we're starting to kind of pierce that 50% line, this new one, the 224.51 that's popped up. But we're failing to close above it. So we've got to have our eyes on it at this point in time because of this right here. And as we get to this point, we can still remain in our long, but we then have to mark from this high to this low and to this high to give us another idea of a projected area for a puts play. You can see the evening star pattern here, and this evening star pattern tells us, hey, we might need to go puts, but we don't necessarily need to hold our calls. Our first calls that we entered those with, basically you'd have to think your stop is this low, that 208.35. Well, now that we got into this point, our stop has become the 212.01 because it's a higher low. One thing that I do at this point with my charts to kind of clean them up is that zero line always represents my stop on a calls play or a puts play. So when it's no longer my stop, I will actually go through and just remove that one line. I'll still keep the targets it gave me, but I want to be able to see my charts and interact with them clearly. Again, as we're progressing here, you see now we've come to our 50% line for our 205.70 projection. And now we're starting to kind of play around in here. And we moved back above and closed above that 50% line. At this point in time, because of how the day straddled that support line, I would be waiting for the following day to make a decision. And you know what? In that case right there, from the open, we went green on our confirmation day. We would exit the puts, but I want you to notice we'd have probably actually lost money, or at least maybe broke even at best on the puts play, but it kept us safe in our calls play. Now, at this point in time, we have a few different targets. See, this one we have to get rid of because we bounced on that 50% line and we got to moving. But we have another area that we need to be watching as our trade's progressing for a potential target. And our stop has moved up. So I'll right click here and I will remove the 0 line because my stop changed for my calls play. Now the other cool thing here is on this day we actually went up and made a higher high. So a very important sequence that was made there. Now as we progress, we see that we have actually passed this initial target, 229.44. And on our long, our 229.44 could actually now become our stop. It hit our target, it exceeded the target. If it were to close back below that target, we would exit out of the trade. As we progress the trade along, you see that we actually come up and we pierce this other target that we had set, but we closed below it. We haven't really pulled back from it because for swing trading, nothing that happens during a day matters. It's the close of the day that matters. So we have a green day because it closed above the close from the prior day. And now you see on the next day we're closing right at this target, but we're still failing to close above it. And now we get here. At this point in time, we have to look at things and say, we've got a few choices. We were trading for this target, but through the progression of our trade, we had valid things come up to tell us that new targets were there. When you opened this new day and began to go red from it, at the point where you give up the open from the prior day, this would be a time where I would either exit a portion of a long position or exit the entire thing. Now also at this point what we have to look at is we've completed this Fibonacci set. This one here still remains because we're right there at that 100% line, but we also need to put in a new Fibonacci set for a downward move, which now takes us to just 227.24. And as we progress through this, you actually see that we come down for a few days here. We penetrate it here, but we close above it. And now we're breaking down through it. So at this point in time, what you begin to look for, because you would have exited at least a portion of your calls, because it's a pullback, you would have played the puts. Your target here has already been breached. And then you have to look at, well, how serious of a move was this one that we were marking off of? And is it possible that a more serious move was this to give us another potential target at 218.18? But if we were to go above the 227.24, we would stop out of the puts trade. And now you see, oh wow, we've actually gapped down below that target And look where it opened, though. It opened right at that target area, and it gapped down from it. Now, when you get a day like this, and you get that much of a drop during the day, and you start to make this wick back up, you need to be exiting at least a portion of your puts. Get down to where you can limit your risk, take some profits on it. Again, as I progress here, we start to see, oh, we're coming back above that target area. And I would use this day, not as my confirmation day, but my day to make me look at the next day. And here again, we are still closing above, but we've got a red day. People are scared to go long on a red day. So let's take a look at it and just kind of start projecting our targets. Now this target, even though it hit below it, you see how it opened right at it, it hovered over it, now it comes down. This is being recognized as a valid point on the chart. And because of how the chart is recognizing it as a valid point, we need to go through here and kind of clean up our chart a little bit to give us some better drawings. We need to look at where this started from. Started from this high to this low to this high. So we're going to mark from this low to this high to this low. And even though I wouldn't be a buyer on this day, I would begin to start looking for the potential of a 234.49 trade. Now at this point in time as well, because this line was broken below, and if you remember, we had an original zero line here that was broken below. This line here is no longer valid, and this line here would be no longer valid because we broke the zero lines. It ruined the sequence. So as we're marking for a projected top area, and we get to moving, well, now we've got a green day. And we've got this 100% line from before at 218.18. And we can very easily tell ourselves that we'd have a pretty minimal risk if we were to buy calls here and use the 218.18, a close below it, as our stop. So the next day you get a red doji day, a little scary, but it still hasn't stopped you out. The next day, a little scary, still hasn't stopped you out, but let's look at what it's doing. It's having a difficult time with the 50% line. At the point in time where it actually pulls back from it, here, you could actually, exit your calls, or you could remain in your calls and take a puts trade using the same tool, going from the previous high to the low to the high, and giving you a 190.66 target. Now we do have other things in the way here. Don't let the clutter of it get to you. If you use this tool regularly, you'll get very used to the use of it and how you can constantly be back and forth with your trades. And the results are pretty well, so long as you trade what the chart's doing and not what you want it to do. Now you look over time, and here we get a drop. Our puts are looking real good. And even though we may have entered our calls up in here, it is really this low that dictates anything to us. And if we've already entered the puts trade, there's not always a reason to just bail on the calls. Again, we see a move starting to be made. The first thing we should think of is running a set of Fibonacci's, connecting the low, the high, the low, and it's now given us a new target for our long of 225.44. Now, as we progress through this, we now see our zero line being breached, and it did close right at it, but it penetrated and fell below. We were using an absolute low price. This tells us now that our puts are probably going to do really well. And because we're right at the 50% line, if we get any positive movement, we'll want to reduce the size of our puts position. Now again, we made a lower low and a lower high on this day. And now we've breached below the 50% line. At this point in time, if you were still in calls, it would only be because they're not worth selling, and you would be up significantly on your puts trade. And now you see this next day, things get confusing, don't they? We already unvalidated this set of Fibonacci's because we dropped below that zero line. We've already unvalidated this set of Fibonacci's because we dropped below the zero line. This set of Fibonacci's is gone with the wind, and we're still currently trading on this set. Now, because this puts play would be doing so good at this time, and the calls play you may have entered up in here, down through here probably wasn't even worth selling. On any positive move that comes back above the 50% line, you would be looking to reduce your puts position, if not sell it completely. But if you got the chance to get something out of your calls, you'd be looking for that opportunity to do so. Now, as you can see, the next day gaps up, but closes to the red. So if you were still in the calls, you would definitely be out of them on that close. And then the next day would have got you. But that is part of trading. That there is part of trading. But it did give us something else to look for. Now, in this case, we would have more than likely missed the opportunity to calls play. Because this day, you would have not been expecting. And then by the time you marked it into this day, you'd see you were almost to the target area. But another thing to look at here isn't always just the little moves that are made, is to look at the overall move. How we made higher lows through here, and then through all of this started making lower lows, lower highs, which gives you another reason to project a move here. And now you can see that even though this one's kind of out of the question, you're right closed above your 50% line at 214.19 with a potential target of 229.77. Now at this point in time, you've already exited at least a portion of your puts trade. And if you chose to take the calls, you could do so with a pretty minimal risk should you stop out if you fall below or close below the 214.19. As you can see, you start progressing here, and then you come and you close below it. The first thing I like to do on this, because of the way how options work and the volatility in them, I'm not necessarily looking to exit calls because of one red day. I may enter puts because of one red day, especially if I'm holding calls. So I have 2 points here that I would be marking. I would be marking this high that happened after this gap down, which you can see when I go from high to low to high, it gives me a projection point of 196.44. But I would also, again, be marking the total move, which you see pop up down here at 179.77. As the trade progresses, we begin to hold that 50% line. We tap that zero line, so even though I might be in puts, I'll still be in them unless we close above this zero line, the 220.34, and I'm still in calls, so my calls are looking a little better. And at this point in time, as you can see here, my puts, I would need to be exiting not necessarily just when it breaks this, because I'm looking for a close above it, but by the time it broke my other set. You see, by breaking above this zero line, right here, it put that old set of Fibonacci's out of the question. And by breaking above this zero line, this all of a sudden was put out of the question. So at this point in time, we're left with a little bit of confusion. The 229.77 becomes our stop for our calls play. And as you can see, the next day, we pull back from it. So at this time, the next day you open right at your stop and you do nothing but fall. You're looking to exit your calls play. And when you exit a calls play that just profited like that did, you look at the points that gave you this target area. So it'd be this high to this low, and now you mark up to this high. And you are given a target of 193.91. Again, as we progress, you're in the puts trade. You're in the puts trade. Now you're down at your 50% line. If you were to bounce here, you would stay in your puts trade, but you could also take calls on the bounce from here. This here, not technically a bounce, just because it's green. It did make a lower low. And thank goodness we knew how to read a chart, because the following day comes up and you're still in your puts trade and you are happy and excited because now from where you entered, if it were to come back above the 214.19, you would no longer be in the trade and would be securing yourself money. Then the next day it comes and it's like, well, shoot, I would have rather sold when it was at 205 as opposed to 213, but I'm still in the trade. Thank goodness I'm still in the trade. And thank goodness we closed below it, but we got really close to stopping out of this one. And on this day, we have to stop out. Now, if you didn't want to stop out of the puts here, you could simply turn this around and run from your low to your high to your low, enter a calls trade, which you could have actually entered on this day or this day, with a target of 237.74, and give yourself an extra day to confirm the move to see which side's going to be your winner. Here you again close above, but you've got that red day, so you don't necessarily want to sell your puts. Let's see what the next day brings. And here you're back below your 50% line. Now, I wouldn't just get scared out of my calls just because they're down, but I'd be happy that my puts look better. Here we are right back at our line. So we're still in our calls, we'd be in puts as well. And on this day here, I shot through too many days. On this day here, this is where the power of that strangle comes in. You know, when I enter a strangle trade, my mindset is I'm willing to lose 100% on one side because I'm pretty confident the other side will make greater than 100%. So I don't like to sell the loser. That loser becomes my insurance policy. So here we are in the calls, looking for the 237.74 target. And this is an earnings day. And here's what happens after earnings. We come right down to our zero line. Technically, this doesn't stop us out of calls, but our puts are sure looking a whole lot better right here. And as we continue to progress, now we've dropped below the zero line. Well, as we know, that changes this high side target because the price has been breached. At this point in time, if there's any value to your calls, you exit them. And you can see now that we have some discrepancies. These zero lines have been closed below. So they're gone. But now our 100% line got closed below. But if you notice here, we have some other things that help us kind of project for potential targets. And you see now we've closed right at this 192.38. With closing at that 192.38, we would exit our puts on any positive movement. The next day actually closes even further below. So as we continue here, we're left with a couple things. We could just hold it until we're really happy, using the 192.38 as our stop. Or we could right click on this line, go to Edit Properties, and add to it our 1618 line. Now if I move the chart a little bit, you'll see it come into play. Because this line could very well be another target area, and our stop is now moved to 192.38. And you see that on this next day, the green day, it come up and it closed right there at it. Didn't stop you out. And on this day,
you would have now exited your puts play at a very significant profit, mind you. Now at this point in time, we're going to take this set of Fibonacci's out, and we're going to look at where the next move would be. So we'll mark some Fibonacci's from here to here and down to here. And we're seeing it gives us a target area of about 208.16. Now, with that, one thing I hope you're noticing already is by engaging in this chart, you would always be in a trade with it. And if you actually study it a little bit and see how the options actually move, you'll see that it'd actually be valuable for you to constantly be bouncing back and forth with these puts and calls, because you'll actually still make money. So if we entered calls with a 208.16 target based on this zero line, we are now going to go through, and we know where our stop is for the calls. And we just saw a pullback from the 50% line. Well, let's take some insurance against our calls. We'll mark from this high to this low to this high, and it gives us a 178.71 short target, and we would now be in puts and calls together. You see that we left this original 100% line because it was still serving as an important point on the chart. You see down here we kind of pulled back to it. Now we shot up above it. And what did we do here? We went right above that zero line that gave us that 178.71 target. Well, that's got to go bye-bye. And on a confirmation day, the next day, if it continues upwards, so do your puts. Well, here we gapped up. Puts are gone. But I want you to look here, because what actually happened was we've now exceeded this 100% line. So I'm going to take this off of our chart so we can see where we're actually at here. Now your 208.18 becomes your stop for your calls trade. And you see we've shot up, and if you're wanting to see where you could shoot up to, and just to give you another visual aid, go to your edit properties and add your 161.8 line. So now you're looking for the possibility of 222.48, so long as you stay above 208.18. And here we are, and we fall below it. This here is where we would exit our calls play, and by using the same tool again, we would be looking for a short trade on puts with a target of 177.53. As our puts play continues, you see a little bit of movement in here. And at this point in time, you come back, you've bounced off your 50% line, and you had a higher high, higher low the following day. Well, here we would run another set of Fibonacci's. You see, this actually takes work. You've got to stay consistent with it. And it's going to give you a target of 230.75. Let's continue here. And you see that this 100% line, we should have actually been deleting this. That trade sequence was over. And where we're going, we need to start watching. Remember, we're already in puts. We didn't stop out of the puts. We took calls because of the positive move. Our zero line is our stop for our calls play. And here we come right back. We hit our zero line perfectly. Make a little bounce off of it, but here we close below it. Now, because we're in puts and calls at this point, I would actually look at holding the calls for the confirmation day. The next day, we get some confirmation. It would be okay to exit your calls. And as you can see, when you continue, this set of Fibonacci extensions is out of the picture, and we're going to continue with our puts down to the 177.53 target. As we come back up to our 50% line, we say, man, I just stopped out of puts or calls the other day, and now it's looking like I should have just held them. Well, when you close back above that, you can either remain in the puts for a confirmation day, which is what I would typically do, or you could look at a set of Fibonacci's here, and then also you have a move here, both of which you would have to be watching quite closely. And on this move here, and this to here, had you bought the calls, you gapped up into your first target. So you could still be holding the puts, and you hit your first target on a set of calls. And once you exceed the target, or pull back from it like you just did, you exit your calls, remain in your puts, and again, adjust your target with a new initial target, 185.55 to the put side. As you can see, we went and dipped below it, but closed above it. But we did exceed the zero line. So this zero line here has to go away. And as we continue, we've now closed below the zero line. So our puts trade is making money. We exited the calls trade because our target was hit and pulled back from. And you see now we're hovering right at that 100% line. And here we dip down almost to our other target with a big close above. Now if it were me in this case, just because of the size of that wick and how close it was to my target, I would have exited my puts trade on that day. And then on this day here, I would have that fib set gone. This fib set is still kind of valid. And I would have my next high target here. And because of this being the day that you'd be looking for confirmation to buy, I'd have to tell myself I need to get over that point. And then use this set of Fibonacci's for a target of 210.70. So I'm out of puts, I'm out of calls. I have no open positions at this time. And you can see you begin to pull back from that point. Well, at this time, I simply go from the last high to the low, back to the high, to give me a new target down in here. And as we can see, we start to progress and we're huddling right around that 50% line. And here we come and we go through 50% line number one, this zero line down here, which gave us the 100% target. That's gone. And the zero line here was just breached, so it goes. We're in our puts trade because of how it pulled back from a target area. And as you can see, our next fib target is 165.66. And on the next day, we hit it perfectly. And we drop below it. And as we come back above it, what do? We exit out of the puts trade. Now, I went through about 6-7 months of the sequence of trades there in this video. And for time reasons, I'm not going to go through every aspect of it, but I hope you saw in this video how you can use the progressions given by your Fibonacci extensions so that you can easily continue through trades, though you need to understand that will mean at times being in both a calls play and a puts play, but knowing where the stops are on those to keep you safer in the trades and help maximize your profits and minimize your losses.